to the Capital Discussions Roundtable. I'm Tom Nunemaker with our guest Bill Ghauri. Before we get started, we have a disclaimer: the Capital Discussion is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that out of the way, I will stop sharing my screen and give you the ball. So welcome back, Bill. Hasn't been that long, but we're always glad to see what you've got cooking.
All right. Well, thanks, Tom. Thanks for having me back. Let me share my screen. Maybe remind me how I do this.
Should be on the Quick Start menu. Or if you're on Windows, you can go Control-Alt-D, like Delta.
Okay, let me see here. Okay. Tell me when you can see my screen.
Yep, it's loading. Okay, we got it.
Okay, let me move this thing out of the way. There we go. All right. Okay, let me, okay. You see the slide? Okay, yep. Good. All right, well, thanks again for having me on. And today's presentation is going to be a little bit of a continuation of what I did the last time. I've developed a backtesting model that I've been backtesting the SPY, and I have been getting some pretty good results. So with that, I've called today's Adventures in System Development. And really what today is about is really the technical analysis that you can use when trading options. And when I say system, I don't necessarily mean that it has to be some sort of automated system. I'm talking about a system of rules and guidelines as they pertain to technical analysis that you may want to apply to your option trading. So first off, let me just give a little disclaimer. Options trading involves risk. It's not, suitable for everyone. Past performance does not guarantee future result. And this is my experience, and your mileage may vary. I have about 12 slides that I'll go through, and I think I can get through these pretty quickly. And then I'll crank up the model, and we'll go through a long system and a short system. And then, because that's where I can show a lot more stuff. But starting out today, I want to give you 3 concepts to think about while I give this presentation. I'm going to go into risk and money management principles again. Now, as I mentioned, I went into this a bit more detail the first presentation, but this is so important that I want to kind of touch on these again. I'll talk about risk-reward ratios. I've got a graphic, I think, that will explain it pretty well. I'll talk a little bit about the performance metrics to use when you, how to measure your trading to see how well you're doing. And then I have a couple of slides on technical analysis considerations as they pertain to options trading. Then we'll do the live demo, and then we'll have some discussion. But after I finish the slides, I think maybe we'll have a little bit of discussion before I launch it, because I don't want to wait until the very end to take any questions. So here's the 3 concepts. As far as I'm concerned, risk and money management is the foundation of any trading plan. You really have to apply these principles to whatever type of trading plan you have. The second is technical analysis is great for finding an edge, and once you've found it, exploit it. Third, you got to measure and record your trading performance, because you can't know how well you're doing if you haven't recorded where you've been. So just as a review, the key principles here on risk and money management is really, it gets down to position sizing. And that is based on the fractional risk and the trade price risk. And as I mentioned in my first presentation, the fractional risk is the amount, or it's a percentage that you're applying to your total portfolio balance or the allocated capital that you're using as to how much you're willing to put at risk for any individual trade. Trade price risk is that amount of price or let's just call it price risk. It's really the difference between your stop price and your entry price. And by using these two values, the fractional risk, your portfolio balance, and the price risk, and the appropriate contract multiplier, which is typically 100 for most of the stuff that we trade, that'll tell you how many contracts that you can trade, the number of contracts that you can trade. The maximum positions per expiration is something that I have found that is important, and I kind of view this as a bit like time diversification risk, because you don't want to have too much concentration in a single expiration. The planned risk-reward ratios, you kind of know this going into the trade, because where you set your stop multiple, stop or slash roll multiple, and your profit target multiple really tells you what you plan to get out of the trade before you even put it on. But if you use risk and money management and you're consistent about sizing your trades, then you can really see some nice compounding in your account. So here's a graphic that I think shows the risk-reward ratio pretty well. This is as an example of selling a put that if you sold it for $1.89 and you had a 1.2 stop multiple, that would give your stop price at about $2.26. So the risk that you have is that red arrow. You can see that that's how much you're willing to risk. The profit multiple at a 0.9 profit multiple, that would set the profit target at about 19 cents. So you can see here the green arrow is pretty large, and that's your reward. So the planned risk-reward ratio, if these were the multiples that you use, would be 4.5 to 1, which is nice. I mean, that's pretty nice. Now, when trading options, when you're selling premium, it's very difficult to get much more than about, I'm going to say 4.5 to 5 to 1, because your stop, I mean, you can't, you have to give the trade some room to breathe. And 1.2 is actually a pretty tight stop. I don't think you can get too much tighter than that. So I'm going to just say that, you know, a 1.2 and a 0.9 is pretty much, you're kind of on the high end in terms of a planned risk-reward ratio. Now, you can use a higher stop multiple, a 1.5, and then maybe set your profit target multiple at 0.8, for example. You'll have a lower risk-reward ratio, but there may be some reasons you want to do it. But your position, of course, is going to be sized based on risk. So therefore, you may want to, well, I mean, it all has to work together to, you know, your risk-reward ratio and your the stops you're using. I mean, it's all a holistic type of thing. So you can't look at anything by itself. But in any event, this is very critical to understand how much you're willing to risk on each trade and what you expect to make. So some of the metrics to look at, you know, to measure the performance of your system, and these are not in the order of importance. For example, win-loss rate. I kind of view this a little bit like a psychological indicator. It's not the most important one to look at, but it does play a role in the sense that you want to have a system that, well, for example, you could have a system that had a win rate of 20% and a loss rate of 80%. But if you were making 100 to 1 on your winners, I mean, that'd be a great system. But psychologically, you may not have the stomach for it to want to trade, you know, 8 out of 10 trades are losers. So I view it a little bit like a psychological metric. But the ones that really are important, I think, are, you know, average win, average loss, profit factor, expected reward, expectancy, which is really key. And then, you know, how well your portfolio does in terms of realized risk-reward multiples, you know, your return on capital, and then your CAGR for your system, and then compare that with your underlying so that you kind of get an idea of how well you're doing compared to the underlying. Sortino ratio is good to know, and as well as Sharpe ratio. Sortino ratio measures the downside variation, and then the Sharpe is both upside and downside. As I showed on the previous slide, expectancy really is key, and I thought it was worth giving the formula so that people could think in terms of you know, what drives expectancy. And it's simply the probability of winning times your average win minus the probability of losing times your average loss. But it's really critical to understand what gives your system positive expectancy, because if you have a system that has a decent positive expectancy, then what you want to do is you want to basically trade it as much as you can without diminishing the reasons that gave it a positive expectancy in the first place. So I guess kind of a long-winded way of saying, if you know what drives your system and what makes it work well, then the more times you can trade it, the more opportunities you can trade it, the better. Because then, of course, that just fits into the whole compounding your account. The next two slides are really this kind of the meat of the presentation, in my opinion, and that is technical analysis as it pertains to options trading. And you know, there's a lot of different ways to approach technical analysis. There's just you know, umpteen indicators out there that you can use, and it's just a matter of really finding which ones that you're comfortable with, which ones that work for what you're trying to do. Note that trend and oscillating indicators, which I use, they are varying. They have varying degrees of lag. They're basically all indicators are lagging indicators. There's really only two that are leading indicators, volume and median lines, but those are really not, they don't lend themselves to being programmed very easily. So your typical trend indicators and oscillating indicators can work, you know, nicely. Just have to understand that they have different degrees of lag. Another thing you may want to consider is a confirmation technique, where you're using multiple indicators and you're looking for some type of confirmation between two. Think of it as sort of like two independent sources are telling you that it's okay to take a trade. The floor concept is one thing that I use for volatility. And what that is that I use this as it pertains to the VIX and the RVX and the VIXN. And that is that there's a certain level of volatility that I'm looking for before I'm considering selling options. It's particularly for puts, but like, for example, just a few days ago when the VIX was down, or I think it dropped below 13, that was not a good time to be selling puts. And so I have I run basically histograms every week, and I look at where the distribution is, and that tells me or gives me a good idea where I'm looking for volatility to be as a minimum to be selling premium. Now the next one here is what I call match fractals with DTEs. This is really important because you want to make sure that you don't have a mismatch between the indicators and the oscillators and that you're using with the DTEs of what you're selling. So it is an example, if you're selling options that are, say, 40, 50, 60 days to expiration, it's not going to do you any good to be looking at a 30-minute chart. That's a big mismatch. Likewise, if you were trading weeklies and we're looking to be in a position for only maybe 3-4 days, a 200-day moving average isn't going to do a thing for you. Now, those are, of course, extreme examples, but that's what I mean about fractals need to match the DTEs. But what you're trying to do is really find a combination of fast, medium, slow indicators that work over a long period of several years or longer. And of course, the best way to do that is with some type of automated system, but you can also do it manually as well. But it's just kind of coming up with a combination that works pretty well, that you can verify its performance over several years. The next is you really have to develop separate systems for long and short trades. There's what I'll say is that applying various indicators, believe it or not, it's not symmetrical. You could be using an oscillator, for example, that most oscillators go from 0 to 100. You might think that, oh, okay, well, if it's an extremely oversold, that'll work for one situation, and if it's extremely overbought, it'll work for the reverse. But not necessarily so. A lot of times you'll see an oscillator stay in a particular area, overbought or oversold for quite a while, and you're thinking, gosh, it really needs to come down here, or it really needs to go up. I mean, it's been crawling along here really low. What's the deal? Well, you kind of have to look at it in the overall context of the trend, because you can find yourself in a little bit of hot water if you're looking at only a particular indicator and only thinking that it has to revert to mean or move off of its low or high. The nice thing for us as option traders, since we're selling premium as opposed to someone who trades futures, we have the benefit of being able to look at volatility. And the nice thing about options is that there's an inherent inverse correlation between price and volatility. When price is up, volatility is down, and vice versa. What's nice about this is that we can design our technical analysis around this relationship. So by looking at, say, for example, the VIX and the SPX at the same time and applying technical analysis to each, it's kind of a nice situation, because we're not just strictly looking at price of an underlying and we're having to choose a direction. Is it going up? Is it going down? As we all know, selling option premium, you don't have to be 100% right, and you can still make money. That's one of the things I love about options, is that you can apply some directional bias to your decisions, and you don't have to be 100% right. Volatility mean reversion, you use it to your advantage. This gets back also to the floor concept that I was talking about, knowing when you should be selling premium and when you shouldn't be selling premium. That's very important, and volatility mean reversion is kind of part of that. Understand what drives your strategy, what makes it do well, and what hurts it. And then you can kind of make sure that your technical analysis that you're applying actually, fits into the particular strategy that you're doing. And then, as I mentioned in the previous slide, you need a separate system for short and long, because what works good for selling puts doesn't work good for selling calls, and vice versa. And if we have time when I do the demo, I will show an alternate case that will be rather illuminating on this point. Of course, the overall goal of technical analysis is to find those high probability entry points for your trade, because it's all about getting a good price for say, for example, in put selling. You want to get a good price for selling your put. I liken it a little bit to real estate. If any of you are into rental properties, or if you're doing any house flipping, you got to buy that house at a good price, because if you don't buy the house at a good price, then no matter what you do, you can't. The market is going to tell you what you're going to get for rent, and it's going to tell you what you're going to get if you flip it and sell it. So if you start out by having paid too much for the property, then you're going to be you're going to be you're going to be climbing uphill to try to make a profit. Same thing with options. If you sell a put and you sell it at the wrong time when volatility is low, and volatility spikes up because being a short vacant position, you're going to be treading water, hoping that you're going to be able to pull a profit out of it, but it's hard to do when you don't sell it at the right price. So that's kind of a long-winded analogy there. Any event, the back testing that I'm going to show today, I actually bought some additional data. So I have data going now from 2005 to 2014. So we can do a 10-year back test. And I'm, again, testing the SPY and the VIX. I'm using a 2% fractional risk. And for the runs that I'm going to do, I'm only limiting it to one position per expiration. I can run two. I seldom, in all my testing, I found that it's good not to go over two because then the risk gets higher with respect to concentration of positions within the same expiration. I found that 40 to 65 DTE works very well. I sell puts with a delta of 20, and I sell calls on the short system with a delta of 30. I'm using a stop multiple of 1.2 and a profit target multiple of 0.9. Positions are sized based on the fractional risk and the price risk. And of course, end of day prices are used for the entries and the exits. So with that, I'm going to do the demo. And also I'll mention that the Excel workbooks with the complete back test results, which includes the trade log, report metrics, monthly log, equity curve, and Greeks, those I'm going to give to Tom so that he'll be able to put those on the website so people can download those. So with that, Tom, do you want to just break briefly for a few questions?
We could. I don't see any yet. So if you have any questions, just type them in the chat for Bill.
Okay. Well, no questions. Let's move on. So the systems that I'm going to show today are I've developed several systems, and the one that I'm going to show today is a long system for the SPY, but it also has a corresponding long system for the VIX. And I've used some different indicators. Really, they're more trend indicators and some oscillators on each to be able to determine optimal entry points. And so I'm going to run this test from 2005 to October of 2014. So it's not to December 31st because I want to have it be able to complete any trades that it takes. The other thing too that and on the money management side, I'm running this starting with a 100,000 portfolio beginning balance, fractional risk of 2%, and one position per expiration. On the other thing that I've gone to is I can either switch between percent OTM or delta, and I've actually in the previous demonstration I was doing things based on a percent OTM. What's interesting is that I now can do choose between the two, and I have found interestingly that running it based on delta actually works better. And the reason I believe that's the case is because delta tends to be more consistent with in terms of representing the risk. And in any good system, I think it's important that the risk remains consistent. So each time that you take a trade, you want the risk of that trade to be consistent. So you don't want to have one trade be a little more risky than the other. And I think, for example, if we look at the trade set that I just generated, you can see the out of the money percentage and the delta. Now the delta, of course, is, I set it to a delta of 20, so we're all pretty close to that. The percent out of the money can vary, and of course this is based on the volatility. So like here we have some that are much higher. So anyhow, I found that delta works pretty good, and I'm kind of sticking with it for now. So anyhow, we came up with about 138 potential trades, and so if we back test those, we get it takes 73 trades. And so, so we start out 100,000. We end up with 1.3 million after 10 years, and you can see what we did here. If we look at the trade metrics, it's easier to just look at the trade metrics. We took 73 trades, 44 winners, 29 losers. So we had a 60% win rate. Our profit factor was quite good at 3.2. Our expectancy is just, it's really good at 0.89. The average DTE of a trade was 54 days. The average days in trade for a winner was 32 days. The average days in trade for a loser was 9 days. And this kind of makes sense, but you notice too that we're just running a little over half. So, and this is very typical that when you do a trade that you can get to 80 to 90% of the credit can be retained or kept within roughly a half or a little more than half of the time. So this kind of shows you that we got into the trades at 54 days and that we were in it for 32. Now this 9 days, what that's telling you is that you're getting stopped out pretty quick. So you're making a bet based on your technical analysis, and then if it doesn't work out, it doesn't work out, and so you're out of the trade. So our average risk reward was 4.6. Now our planned risk reward is 4.5. The reason it's a little higher is we're using end-of-day prices, and that's what actually works to our favor a little bit. We had 8 consecutive wins, 4 consecutive losses. The return on capital was about 1,200%. Good Sortino ratio and surprisingly nice CAGR for the strategy at 30%, and the underlying CAGR was about 5.6, so substantially better. Now if we look at the equity curve of that, and I have to...
Well, that's loading. Jay asks, what's the difference between expectancy and expectant score?
Let me go back to the metrics here. The expectancy score. Expectancy score is actually, what that does is it gives you a score based on if you're comparing different systems and they have different time frames that you're looking at. Let's say you're looking at one system and you're testing that over a 3-year period, and then you're testing another system, and then that happens to be over, say, an 8-month period. Well, it kind of normalizes it based on the number of days that you're in the system. So that doesn't really mean, actually this value means nothing unless you're comparing it to other systems. So you can disregard that because that only has a value if I'm comparing multiple systems, which I do, and then I look at that value. So, but expectancy is really the key one there. So with the monthly log done, let me generate our equity curve, and so here you can see the equity curve looks very nice compared with the buy and hold. So one of the interesting things is that in the system that I'm running, I have some technical analysis based on a long-term trend indicator, and when that trend slope is negative, you're not taking any trades. So this is why this is flat. There were no trades to be taken during this time, and of course we know this is the when you know, the financial crisis, and you know, everything went into a meltdown period. Now it because of the return on this looks so nice, we forget that this is a 50% drawdown here in the SPY. So you know, comparison with the SPY, it's you know, really, you know, amazingly good. If we look at the portfolio balance variation, you can see that based on our fractional risk of 2% and a 4.5%, I mean a 4.5 risk-reward ratio, theoretically every trade that's a winner should make about 9% on our portfolio. Well, it's pretty close. The reason it's, you know, a little different is because of, you know, using end-of-day prices. But everything above the blue dotted line is a winner, and then everything below and a red dot is a loser. But the important thing is that you look and you see how much is your portfolio balance increasing. This is percentage here. So how much is it increasing for every trade versus how much is it increasing for every losing trade? And this is what you want to see. These numbers here higher than these are lower. And these
are for short options. That's the strategy. A short put.
This is the long strategy, and I'm going to demo the short strategy next. But first off, I'm going to show you the Greeks here. This is just a table of the starting Greeks for every trade, and it's kind of interesting. And when you get the workbooks, you know, if people download the workbooks, they can actually play around and chart some of these things and see, you know, how, like for example, if you look, let's just do a quick chart here of. You know, this is the VIX of all of the trades that this took, okay? Now, if you notice here that it did take one trade here in 2006. Oh, actually one here at 11.2 in 2007. There was probably one of my rules said that because it was such a substantial move that it went ahead and took that trade. But normally, I had a filter in there to say, except under very certain circumstances, it had to be above 15 in order to take a trade. And these were those certain circumstances that it still took trades. And so it's kind of interesting that you can do, you know, look at some of these. The other thing too is, like for example, I mentioned about out of the money versus the delta. So if we looked at that, and let's just throw one of these on a secondary axis, okay. And this is my point about the consistency of delta versus percent out of the money. So for example, the delta here, I set the model to select strikes with a delta of 20, and you can see that it didn't. I mean, some of them, I mean, it's pretty close. There were a couple here that it selected strike. There was a delta of about 17, a delta of about, again, 17 something, 70. Okay, so you can see that the consistency of delta versus percent out of the money. Okay, this is percent, so it ranged from 4% down here to 12.5%. Here again, let's see, 12.7%. So it's kind of all over the map. And this is one reason why I think the system performed better, was because delta is more consistent, and that consistency means the risk to your portfolio is more consistent. So anyhow, that and then what I can do is I'm going to save these. I'll call this long SPY, and let's see, 326.15. Okay, so I'm going to save this, and now there's the whole workbook, so everyone will have that to play with. So with that, let me now do the another system, the short. Well, actually, should I take some questions here? Anyone have any questions on the long system?
Yeah, we do. Now, you say long system. Does that just mean you're buying calls, or is that spreads?
No, you're just selling puts.
Selling puts. Okay.
Yeah, this is it. We were selling puts with a delta of 20, 40 to 65 days to expiration. And we had a stop multiple 1.2 and a target multiple of 0.9. So that was the drivers. So this is what I call the long system.
And then Andy asked, can you please clarify how you chose 73 trades out of 10 years of available trades? What particular trade? I see you're selling 20 delta, but which ones? What was required?
Yeah, the way that I do this is that I have in the model logic to say when the technical analysis says that it's an advantageous time to sell puts, then the model basically says, oh, okay, is there anything out there that I can sell that fits these parameters? That's 40 to 65 days to expiration, that has a delta of 20, that has a minimum open interest of 5,000. So I let the program tell me what fits that profile, and then it generates what I call a trade list, and that's a list of potential trades, and it'll select the strike, and the expiration. So that's really the main things that drives the back testing. So for example, on this date here, October 5th, 2005, apparently there was a signal to say, hey, this is a good time to sell a put. So the program says, okay, well, what should I sell? Well, I want to sell a delta of around 20, and it needs to be between 40 and 65 days to expiration. And it needs to have at least 5,000 minimum open interest. So the program says, oh, okay, you know what you can do is you can sell a 115 put that has a November 19th expiration. It happens to be 45 days to expiration, and it has a delta of 20. Bingo, I'll take it. So it goes down through that with every single date. So the process of determining which strikes to sell and when to sell it, the when to sell it is based on the technical analysis, and that was what I showed in the presentation about some of the things that you can use in terms of technical analysis. The what to sell is based on the logic of how many days to expiration, what is it that you want to sell, what's the delta you want to sell. So it's that's how I determined which ones to trade. Did that answer the question?
I think so. Jay asked, what's the long-term trend indicator that you use in the long strategy to stay out during down moves?
It is incredibly simple. I'm using the slope of the 200 moving day average.
That is simple.
Yeah. Here's the thing. I've tested quite a few systems. I mean, in fact, I had to clear out. I had so many systems in here, but I had to clear them out because they were getting so they were really getting too much. And so as I tested through the systems, and then ones that looked good and didn't, I mean, it was a continual refinement process. But what I found is that simpler is better. However, you don't want it too simple. But here I will tell you this. the system that I had demonstrated last time, where you're selling when the SPY is over the 200 SMA and the volatility has had a 10% pop over the prior day, that's right there is a pretty decent system. I've improved upon that, but that system right there is not bad, and that's about as simple as you can get. And the other thing too, keep in mind, is I talked about the lag of indicators, whether they be trend indicators or oscillators, is that a 10% move over the previous day, there's not a whole lot of lag to that. I mean, when you're trading at end of day and you're looking at the VIX and it's up 13% for the day, you don't need an indicator to tell you that, hey, you know what, maybe I should be selling some premium today. So, but going back to the technical indicators, I mean, there's quite a few that I actually still want to test. But I found that some of the pretty common ones work pretty good, especially when you use them in combination together with some others to get that, like I mentioned, the confirmation technique and stuff. So there are ways that you can kind of do it, and it's just a matter of testing these to come up with systems that work and that are reliable under different market conditions. But also you have to have systems both separately for long and short systems. And the one that I'm going to demonstrate here, I believe this is it. So let me do that. Money management, I'm not going to change. But here I'm going to sell calls, and I'm going to sell a 30 call. So, yeah, okay. Yeah, so I'm going to sell a 30 call, and this is a short system. Now, this system doesn't take as many trades because this particular system is based on well, this one actually, I talked about matching fractals and such. This one is kind of more, you have to be in a clear downtrending market in order to run this system. But, and as you can see from the potential trade dates, it was basically taking trades in 2008 and 2009 and then a couple times in 2011. So this is a system that's designed for, really downtrending markets. And so here we go. It did quite well during this period of time. If we look at the monthly log, and let me look at the trade metrics here. So for example, it only took, we ran the back test from basically for 10 years, but it only took trades for a very short period of time because for this particular system, because this is a system for one that's in a clear downtrending market. So it only took 12 trades, 9 were winners, 3 were losers. So it had a 75% win rate, but it had some really good stats here. Interestingly too, is that average days in DTE was 53, but the average DIT for a winner was only 23 days. So it was a little less than half. Compare that with the long system, which is kind of an interesting thing. But notice here that this system, which let me show you the chart because that's probably the best thing here. You can see that the system here, it didn't take any trades until here, basically in 2007. Then it started taking trades. And then it was out of the market all of this time. and then there were some signals to get in the market again, and it took one trade. So this is what's kind of interesting. If it in January of 2005, if you bought and held the SPY, started with 100,000, it went up, went down, went back up. This short system alone, which roughly you were in the market 10% of that time. So over that 10-year period, you were only in the market 10% of the time. You still beat the underlying. Now, another thing that's very interesting too is that you look at the Greeks and look at the VIX, okay? I ran this system actually with no technical analysis applied to the VIX. Technical analysis is only applied to the underlying, not to the volatility index. But look at the VIX. That I mean, these were the values that we were selling premium at. I mean, you know, this is why you were making good money, is because you know, the volatility was high. So even though we weren't actually looking for a vol pop, the volatility was good. So we actually got we collected some nice premium. I think that's also reflected too when you see that look at the average entry price was $1.93. So we collected pretty good premium for selling these calls. So that's and actually let me see here. Let me save this system here so that and let's see. Okay, so there we go. So and so yeah, people will be able to get the trade logs, the monthly log, the backtest results, the metrics report here, and the chart, and the Greeks. And so people can play around with that, and there's some interesting things that you can do, some relationships that you can chart and see and stuff. So those are the two systems that I wanted to show, the long and the short. So what I'll do is there's a variation that I do want to show of the long system, but should we take any questions? Is there any more questions here?
Yeah, there's a couple. Robert Duffy asked what's the criteria they use to select the trade, but I think you have that trade parameters when you're doing this process.
Right.
Jay asked, in the short system, is there a volatility number that's required to take a trade?
I'm sorry, what was that? Was there
in the short system, is there a vol number required to take a trade?
No. No, there isn't. Not for the short trade. Now, I have done systems that do have it, but what I'm demonstrating here is a system that I found to work pretty good. I mean, it's not optimized, but it's pretty good. And so I wanted to show a system that wasn't too complicated, yet gave pretty good results.
And John, just clarifying that the technical analysis of the short system is also based on the slope of the 200-day moving average?
Yeah, that is one of the criteria, yes.
Okay, and then ML asks, what's the degree of slope?
If it's above 0, it's positive. If it's below 0, it's negative.
Simple enough. And then Andy asks, in the long system, you're selling 20 delta puts with VIX over 15 and a 200 moving average positive slope. Is there anything else?
Yeah, there's actually a number of things that I do. That I use 2 other different moving averages. I look at the relationship of those fast and medium term moving averages and their relationship to each other. So yeah, there's quite a bit more.
I'd imagine that's a good starting point for any research.
Yeah. Oh, yeah. I mean, I tell you, I want to try a little linear regression here. I got some ideas on something I want to do for that. So, but let me go ahead and do I want to show something here that, I think I was kind of able to demonstrate here that if you, when you sell puts, the long system, as you saw, did pretty well. It does nicely. Now, if you say, hey, if I were doing let's say an iron condor, for example, and you're thinking that, oh, okay, I'm going to wait for a vol pop to sell some premium, to sell my calls or I'm sorry, to sell my puts or my put credit spreads. So you're watching the VIX and you're watching your underlying and you're saying, hey, now's a good time. Let me capture this high premium moment here, and you sell your puts. And then you're thinking, well, I'm an iron condor trader, so I got to put on the call side. Wrong. If it's a good time to sell puts, it's a lousy time to sell calls. This is why you really need to, I mean, this is kind of a bone that I have to pick with a lot of books on trading the iron condors, because they drill this into your head that you got to put on a balanced position right away. In fact, a lot of them even advocate entering a four-legged trade. A condor is a one-shot deal. I personally think this is the wrong approach. And the reason I do is because you can use some fairly simple technical analysis, watch the volatility, and you can figure out some times when it's advantageous to sell puts. But don't go turn around and sell calls right away, because you will lose. In fact, the better your skill at selling calls, when you're selling puts or put credit spreads, the higher your skill level is at, if you're putting calls on at the same time, you're gonna lose equally as well. And here's my example of this. I'm gonna sell calls on the long system. So this is like running the system in reverse. And if we do this, you'll see that it'll come up with a list of potential trades. Running a little slow today. Okay, so these are potential trades that it came up with. Now the dates are the same as it would have been for selling a put, because it's based on the technical analysis for selling puts. It's a long system. But what we're going to do is we're going to sell calls at the same time. So it's kind of like thinking if we were going to do iron condors on those dates. So if we ran this system, you see a lot of red. In fact, you start out with 100,000, you end up with 39,000. So if you look at the metrics of this, it took 63 trades, 12 were winners, 51 were losers. So we had a 19% win rate. Okay, we have a negative expectancy. I mean, you're losing money. So what this tells you is that when, as I said in the slides about technical analysis, when it's a good time to sell puts, and if you've done your homework and and your skill level is pretty good about knowing when to sell puts, don't sell calls, because statistically you will lose money.
Very interesting.
So that was kind of one of the variations I wanted to show. And if I did do the graph for that, just for grins. So here we are, the green line. So now granted, we don't lose as much on the calls that we made on the puts. I mean, we do make very good money on the puts. So one might argue, well, you know, that's relatively speaking compared to the calls, I mean, compared to the puts, you don't lose that much, which is true. But the point is that statistically, it's not in your favor to sell calls when it's a good time to sell puts. Now, what I would advocate is that when it's a good time to sell puts, you sell the puts, and then just give yourself a few days for a little bit of a rally, and then sell your calls. That would yield better returns, because keep in mind that when you do sell the puts or the put credit spreads, you're still exercising your risk management on that trade. Because what I do is I basically treat selling puts and selling calls as two completely separate activities. One doesn't depend on the other. If it's a good time to sell puts, I sell puts. If it's a good time to sell calls, I sell calls. And each one has its own risk management. And I think I personally find that to be a much better way to trade. So that's really kind of it.
And Manju asked at the beginning, what's the exit criteria? I think you're just setting that with your profit targets and stop losses.
Yeah, right here. Profit target multiple is 0.9.
So if you sell your call or put for $2, and when you've made 90% of it, you exit.
Exactly.
All right, I think that's it for the questions, unless there's any stragglers. But thanks again, Bill. Always interesting to see your back testing and charts. I love those individual trade charts. Those are fantastic.
Oh yeah, they're kind of a great way to analyze a trade. And here's actually one thing I'll mention is that this method of trading here is, well, it's back testing, but it's based on, of course, the technical analysis and the risk and money management and things like that. When it comes to actually trading this for real, the thing that I do, because this is kind of I've migrated quite a bit from trading broken wing condors to really now just kind of more naked puts and naked calls, is that I do roll positions. Because one of the things, as you recall, I had a slide in there about the expectancy. If you've got a system that has a good expectancy, positive expectancy, you want to take trades as much as you can. So what that means, like for example, if we just take a look at what happened the last couple of days, we had a really nice vol pop. Okay, well, I sold premium. I sold some puts, because it was it was a wonderful time to do it. It was above my floor. The VIX was above my floor price, and my technical analysis was saying, it's a pretty good time to sell puts. Well, guess what? After this morning, it gapped down. Well, I had to roll a position because it hit my 1.2 roll price. Now, in this model, I'm closing the position out completely, but in reality, I roll them down because I view that as an opportunity. I don't want to miss this opportunity of not having a position on. So in reality, you can roll positions down when you don't have to just close them out. Now, I do treat a roll as a loss, but the other interesting thing too is when, I had a stop multiple of 1.2. Well, when it actually, and these were naked puts in the SPX. Well, when I actually rolled them, and I roll them with a vertical spread, I buy a vertical. So I buy the short, and then I sell a long further out. So I roll it down. Well, as you know, we gapped down this morning, and the VIX had, volatility had popped up a lot. Well, despite that, I waited. Of course, I don't do everything right at the beginning of the market open. I give it a little bit of time for things to settle down. My roll price is 1.3, so a little slippage there. Rather than 1.2, it was 1.3. But it just goes to show you that if you stay on top of it, and of course it rallied a little bit after that, and but when it comes time to either closing out or rolling a position, you just have to do it. You can't. I mean, you don't want to be in the prediction business of saying, okay, well, maybe it's going to come back. That's not a good strategy. So when it's time to roll or it's time to close out, you have to do it. So when it comes to trading this for real, I use standing orders for the my profit targets. Those are always in. But the stop or the roll price, I just use alerts because I like to have the flexibility of knowing, oh, okay, it's hitting it. I can take a look at the technical analysis at the time, and then I can, work the order, and I find that a little better than just having because first off, if you have standing orders in, and I mean, if you've ever watched the SPX, the difference between the bid and the ask, the width of those spreads, just at the market open or pre-market, I mean, it's nuts. So you don't want to get caught in that. You want to let things simmer down for 15, 20 minutes, even if it's gap down. Let it just simmer down. At least that's my view. Just let it simmer down for a little bit, and then do what you have to do. I do see a question here, do I roll the same size? Generally, I do for the first roll, but if it's depending on what I have in terms of positions on and how many are in the same expiration and how many DTE that I could put on a new trade and whatnot, I may put on, at the time that I do a roll, I may actually increase the size, but it may or may not be in that same expiration. And it may or may not be that same strike. So, I don't have any hard and fast rules other than just the overall risk and money management that I like to try to keep the risk to the portfolio as constant as I can. I see another one. Do you roll during the financial crisis? How did you do? Actually, I got out. I had, when I was trading back then, I had a rule. I was trading mostly the RUT, and when the RVX got over 35, that was my kill switch to get out. So once it got over 35, and that was based on earlier testing that I did, and those were primarily long positions that I was doing, but I was out for, so I was out for a good portion of that. And now that's interesting. Here's a question here about, do I roll to a new 20 delta put? Generally, I try to keep it around 20 deltas, but there's an interesting thing if you're trading spreads, that not all spreads are created equal. And I actually showed Tom a little bit of this earlier about how you can actually pick a spread that gives you the best bang for your buck. You can rank spreads and according to risk, and then you can basically pick the spreads that fit a certain parameter that offer the highest premium for the lowest risk. But maybe we'll save that for another presentation.
Yeah, that was pretty interesting, but we're definitely out of time for that today.
Yeah.
Morgan, can you show us, do you have a combined equity curve handy for the long and short together?
No, I don't, but I'd love to see one. See, I'm running systems at this point right now. My model is just set up to either run a long system or a short system. But you could actually, when you get the 2 workbooks, if you wanted to create your own, I guess you could, because you'll have all of the data. I haven't modified the model because, the more I work with, the more I've done this back testing and everything, the more I am just really treating a trade as either a long trade or a short trade. I've moved very far away from combined option positions like condors or butterflies. Even broken wing condors I'm not really doing anymore. I'm just pretty much directional, based on technical analysis and risk management.
Well, I think that's it for the questions. So, and we're out of time anyway. So, thanks very much, Bill. Another outstanding presentation. Really appreciate it. I had some comments. Other people agreed with me, and hopefully we can get you back on to go over the that spread thing you were showing me, because I think that's an interesting presentation by itself.
Yeah, well, I'll look forward to putting something together in the future for that.
All right, great. Well, thanks everyone for sticking with us to the end, and thanks again, Bill, and we'll have you back soon.
Okay, great. All right.
Thanks,
Talk
everyone.
to you later.